Hey guys, welcome to another week, another time, another discussion about business, entrepreneurship, and hey, let's figure out how to either get you in a right place to launch your next business, side hustle, opportunity, empire, or if you've already got your business rolling, there are just so many different things to think about. So scaling, what does it take? But one of the most important things in the world, doesn't really matter what you're doing, where you are, one of those necessary evils, kind of like filing taxes, you just got to do it. Bookkeeping, accounting, making sure you know what's going on with your business at all times. And we're going to dive into the different ways to look at it and things to consider. But I'm here today with a really good friend I've known for, God, probably 15 years
I
at
think
this
it's been
point.
longer.
Man, time flies when you're having fun.
Really.
But seriously, she helps me with a lot of my investment projects, businesses that I'm operating, a lot of deals that I'm partners in. She helps because I know, like, and trust her. And at the end of the day, everybody that you work with, you should know, like, and trust. And if you don't have any of those, by God, get rid of them. But today, we're talking bookkeeping and accounting with Marie Jackson. Marie, how's it going?
Hi, I'm great. Everything's good. How have you been?
Oh, life is golden, moving, shaking, trying to do new things, acquiring new businesses, selling other businesses, and just trying to make the most at a time. So, I share with this at Entrepreneur. We are trying to help other people launch their own business, scale their own business. But the reality is, Jillian Sidoti and I, both the hosts, we're entrepreneurs ourselves. We don't talk to anybody that we don't know, like, or trust. We don't share anything that we haven't lived and done ourselves. So it's that's why we're here, and we got that necessary evil of bookkeeping and accounting, which
Yeah.
you're the pro. Can you?
Somebody has to like to do it, right?
And God knows it ain't me. It's no, I have this concept of kind of one of the things I think about in business. You've got these money making activities, marketing, sales,
Yeah.
production of whatever it may be, and then it doesn't make us any money, accounting,
Yeah.
HR, administration, but so very necessary, and you got to do it.
It's your decision-making tool. Yeah.
You nailed it. So
Yeah.
if you don't mind, give a little bit color on your background, what you've been doing, and just so that
Sure.
everybody knows who you are.
Yeah. I started out in operational management actually out of college and worked a lot with the management teams, the operations of companies, doing a lot of the budgeting, P&L, making sure, so I still was working in the financial sector of it, but it was more of operations. And then about, I want to say 18 years ago, I went into accounting full on, decided and just, started working with a CPA, worked with the CPA for 5+ years. I continued to work with him even after I stepped out on my own, worked my way up, did a senior accountant position, a senior international accountant position, went to controller and then a CFO for a company before I decided to go out on my own. And so now I ventured out.
So what you're saying, you're a newbie?
Yeah, no. Yeah, I'm very new at this.
Well,
trust
I
me.
love, before we get in, and I want to talk really honing in on financial statements and how they work, what they're for. But thank you so much for joining. Wanted to give you a minute or two to pitch your own business, Funders Bookkeeping. And very admittedly, for everybody that's watching, I asked Marie to make an offer to you as a budding entrepreneur, as well as we work with literally hundreds of deal makers doing thousands of deals every single year that require bookkeeping. So with that, I do want you to talk about it, but really check out this offer at Funders Bookkeeping. Just the website itself, fundersbookkeeping.com. Learn more about what Marie's doing in the bookkeeping side. This is where it gets exciting with info.fundersbookkeeping.com/done-for-u. I'm going to pull up the website, but I think it's awesome and so very, very needed for absolutely everybody. If you don't mind, could you share a little bit more about what you're doing and what you're offering?
So the thing about Funders Bookkeeping is that we're very focused on helping entrepreneurs, helping small businesses. A lot of small businesses get started and they think, let me just do this on my own. So we wanted to, and that's where they make mistakes, because finances is the one major thing that makes a business fail or creates a fail for a business. So we created this opportunity for new businesses that are just getting started to come in for a very, very low price of $50 a month. And that is, that's a dinner out, so, and we're going to take this on for a month. It does have a limited amount of transactions that you can do, but we're going to help you get started with this special offer. So if you're getting ready to just start a business, or if you've just started a business and you have very few transactions and you're just getting going, but you don't know how to grow, this right here is going to be perfect for you.
All right. And so let me do a real quick summary for everybody, just so it's not missed. You're starting your LLC. You just got it formed. You got to do bookkeeping, but you haven't really started. For only $50 a month, which is literally the cheapest you will find absolutely anywhere.
Yes.
You will get your financial statements, up to 50 monthly entries, a couple of minutes to talk to an accountant. But let's be perfectly honest, it doesn't matter that much, because you're just getting started, you're just getting rolling, and it's something that's really important to do, but nobody likes to do it. So definitely check it out. Here's the website. I've also shared it, info.fundersbookkeeping.com/done-for-u. All right, that was fun. Now I actually want to talk about the important stuff.
Yes.
And, could you just, so that everybody understands, base level, what is bookkeeping? What is that versus accounting versus finance? Like, we all hear all these different things. God, when do we need what? And I don't even understand the differences. So could you explain?
Yeah. So bookkeeping is where you're going to collect your data. That's your records of your financial data. It's basically your day-to-day. That's the, knowing exactly what money's being spent and where it's going. Accounting is more of organizing and analyzing that data, reading those financial reports, interpreting the data to the client or the business owner so that they can understand what it means when they look at those financial reports and help them make decisions. Finance is where you get deeper. So that's where you're going to make your decisions to grow. When you're working with someone in finance, you're looking to grow. You're looking to make strategic decisions. You're looking to have all of your business information in one place and have someone analyze it to a point where they can tell you, this is what you need to do to grow, or these are your key point indicators that will help you grow.
Got it.
So
Like,
they're very different, but they're all within the same family.
so we just get a little bit more and more higher level and complicated, but it's like you have to have the data to do the analysis. You have to understand the analysis to get the financing and make major decisions. So that's kind of where it all wraps in together, correct?
Correct. Yes.
Okay. There is actually a title that I have also no clue what it actually means. Controller. I heard CFO, Chief Financial Officer. We know accountants, we know what they do. What's a controller?
So a controller really is that main person in a company that manages all of the financial department. Your CFO is your high level, basically a high level controller, but your controller is your second in place from the CFO. This person is the one that is going to really dig into those reports, really dig into the daily. They're going to be watching everything at all times. They manage all bank accounts and the credit cards. They manage all of the money coming in and going out. And they know everything about that business. So if one little thing is off, that's the person who's going to notice it first, is that controller.
Okay, I got it. Now, that's great. Before we get into what the financial statements and kind of what bookkeeping really looks like, I have what I think is the absolute most important equation there ever was when we start talking about finance. The very classic assets minus liabilities equals owner equity. And I'll explain that equation, and then let's get in a little bit deeper with that. Let's talk about assets. Assets is what your business owns.
Yes.
It's the positive side of the balance sheet. Minus liabilities, and that's all the debts. It's what you owe to who. And if you take your assets, you take away what you owe, you're going to get, with, in accounting terms, it's owner's equity, but the reality is that's net worth.
Mm-hmm.
Every time you start getting asked that good old classic, what's your net worth? You have to fill out a personal financial statement for any type of financing you're ever doing. What's your net worth? Your net worth for a business equals owner's equity. Yeah, it really is that simple. But I'd like to kind of break it down step by step by step. When we talk about assets, we have multiple types of assets.
Yes.
Can you speak a little bit to what categorically what assets there are? And let me know if we're kind of jumping into balance sheet type stuff. Great. I can pull up a sample balance sheet so we can kind of look at it.
Yeah, we are jumping into a balance sheet. That's absolutely where you're going to find your owner's equity, your assets, and your liabilities is on your balance sheet. And with that, assets are your cash, your equipment, your furniture, your buildings, your accounts receivables. If you have accounts receivables that haven't been paid yet, those are also considered assets. These are everything that's going to either stay within the company as a foundation of it or is coming into the company. Liabilities. Did you want to
before we get to liabilities? We're looking at just a sample balance sheet, and don't worry, this isn't actually somebody's balance sheet.
No,
Ask somebody to fill it out. But since we're now looking and talking about a balance sheet, just want to be really clear that it is a snapshot of the company in a single day. You pick out the day, but all of this information, it applies for an instance of time. We'll talk about the other financial statements that cover other operational analysis type information. But I just want to be clear, because balance sheet comes up all the time, it's a snapshot. That answers that. assets minus liabilities equals owner's equity. But there's some other terms on here that I want to ask you about. Current assets. What does that mean?
Current assets are going to be more like it's going to be your cash. That's a current asset. It's going to be your equity that the owner put. Well, not really the equity. It's anything that you currently are that's there that has full value. Because if you're doing accrual, then some of these assets aren't going to have full value at that point.
How is accounts receivable a current an asset at all? You don't have the money yet.
No, accounts receivable is an asset. It's because money is due to you. And so if you have a customer and you've already sent them an invoice, but they haven't paid that invoice yet, that's an asset. That's money that's due to your company. So you know that money's coming into cash. So it will stay within your current assets.
Got it. And if you could just, tell me if I'm right or wrong. I remember taking accounting. It's only been, God, I'm getting old.
I know it's been forever.
25, 30 years. Never mind. Let's not talk about how long ago it was, but I took an accounting class in college at some point. I remember current assets means that you can liquidate or use whatever it is or expected to use it, have it within a 1-year time period. It's basically your liquid assets that you have immediate uses of.
Immediate money, yes. Immediate cash if you need it, yes.
Got it. Okay, and then we have
you did a much better job at that description.
I am apparently remembering back only 30 years.
Only 30.
That's it. Time flies when you're having fun. All right. Other asset type. We have fixed assets.
Yes.
What does fixed assets actually mean?
Fixed assets would be your buildings, your equipment, your computers, your a software program that was built for you would be considered a fixed asset.
Okay.
It's those are the things you can touch. They're there, they're solid, they're not going anywhere. And it's going to take you some time if you need to sell and get and liquidate them. So they're not, it's not a quick fix for anyone, but they give the company a lot of value.
Okay.
And they also depreciate. A lot of them depreciate too, as well.
And people don't really understand depreciation. You buy something, you're paying full price for it, but through time, like the value goes down. That's at least how I understand depreciation, but there's kind of different ways to do it. Could you speak a little bit to, did I actually describe depreciation correctly? And if so, what does it really mean as it applies to a balance sheet?
So depreciation, the way it's, okay, hold on. You threw me off guard on that one a little bit.
Sorry, I'm throwing you right in the spot. I know we are kind of, is it more like tax issues or is it more like balance sheet?
More like the useful life of the asset.
Okay.
So, and it reduces the value of the asset over a certain amount of time due to like wear and tear. So basically you can have a fixed asset, but it's not always going to be worth what it's worth. It's like buying a vehicle.
Yeah. Let's use a vehicle as an example. That's literally exactly what I was hoping to bring up. How do you depreciate it? And does that mean we can only sell it for that amount?
It doesn't mean that you can only sell it for that amount. Depending on the asset, there's different depreciation rates. And how it works is you take the, okay, so the reason you're depreciating the asset is because you're not going to forever have that asset. So it's a slow it's a slow decrease in your asset balance. So your business could have this brand new vehicle and it's considered a fixed asset. You've got this, it's got worth this much money. Well, 5 years from now, it's not going to be worth that much money. So you're not going to want to be paying taxes on an asset that you don't still have that's worth the same amount of money that you bought it at. So depreciation actually helps the client with their taxes year by year as that value of the asset continues to,
So to give a live example, and this is based on at least how I've been treated, and tell me if I've been treated wrongly. I buy a car for, easy numbers, $21,000. I understand there's like a 7-year straight line depreciation as one of the options.
Mm-hmm.
So for 7 years, for bookkeeping purposes, it's worth $3,000 per year less until it's worth zero. Is that correct?
Yes.
Okay. But if I sell it 5 years later, it has a value on my balance sheet of only $6,000, but I sell it for $16,000. What is that extra $10,000? Like I'm selling it for more than the value. Okay. So it's actually profit. It doesn't matter where the depreciation is. If you sell it for more than that depreciation value, you've made money from a tax perspective.
Yes.
Perfect. That makes so much sense. Thank you for, going a little bit deeper into the assets side of the equation. Next, let's quickly talk about liabilities.
Yes, liabilities. So liabilities are going to be your loans. It's going to be your, if you have a line of credit or you have a bank loan or you have salaries that are payable are considered liabilities.
Well, before you go on, let me know if what you mean, if I'm paying somebody $2,000 per pay period, whatever that may mean.
Mm-hmm.
Is it showing as a liability until I pay it? Or are these employees always liabilities? And I'm thinking more, hey, it costs $50,000 per year that I'm paying down. Like, how do I think about it?
So a payroll liability is just or I guess it's a salary payable is only until it's paid. So a certain amount might sit, especially if you have people on salary. You know that your next month, this is how much that salary is going to cost you. So that's considered a liability until the end of the month. And then it's basically going to renew anyway each month. But if you lose people or gain people, it will increase or decrease.
Okay. Also, with liabilities, we've got current liabilities. Does that kind of just mean you owe it now versus is there some other category?
Current liabilities would be like your payables. They would be your similar to expenses. They're liabilities that are due each month.
Okay. So that is like the payroll, or would it include if I bought a car?
Liability.
What would it be if I bought a car and I have a 5-year payment plan, or I'm paying a loan off over 5 years? How does that get categorized as a liability?
So a vehicle loan would be categorized as a long-term liability. Anything that's over 5 years or more would be categorized as a long-term liability. And that's to show that the company is going to be carrying this debt for a while.
Okay. And to keep talking about a vehicle only because it's easy in the concept of this assets minus liabilities equals equity. Mm-hmm. So you own a car, that's an asset.
Yes.
You subtract from, then you depreciate that asset year after year.
Yes.
Now you subtract out of the depreciated value whatever your debt that you owe on it is, correct?
Yes.
Okay, and then we have the equity, the value of the vehicle.
The value, yes.
And so if the depreciated value is higher than the loan, then you have positive equity. And if your car is an old beater and the loan is way more, then you have negative equity. Is that the way that it works?
Equity can be positive and negative depending on what's due, but it really just gets down to a zero balance. Once it gets to zero, it's zero. So then you just have the liability. If the car's not worth anything and you're still paying on it, then you're in trouble.
Fair enough. Well, I mean but that can happen though. If you got a 10-year loan, I know they don't really offer those, but a 7-year depreciation, you could be paying on it past the point the bookkeeping says or the accounting says it's worth zero. Yes. But if you sell it, you're still selling it for more than zero. It's just that's a function of accounting, correct?
Yes, it can get very complicated.
All right. Well, let's not dive too deep into it. Let's talk about the fun part of it, the net worth, aka the owner's equity side of a balance sheet.
Yeah.
Can you explain kind of categorically what is owner's equity? What's it made up of?
So owner's equity is initial investments that the owners make in the company. It's also your retained earnings. So profits that are kept in the business that, if one month you had profits of 20,000 and they weren't used and you go into the next month and you look at financials, you're going to see retained earnings and you're going to see that 20,000 in there in retained earnings. And then it does have a negative in there, and that's the distributions. And so you can, you'll have your retained earnings and your initial investments or owner contributions, like if owners need to put money into the business to keep it going or to, start it up. And then once the company is making money and the owner starts taking a little bit for themselves, those are called owner distributions. And so that's going to come away from that. And then the balance would be your owner's equity.
Got it. And if I can just make up an example. Yep. Correct me where I'm incorrect or wrong. If I started a business and I put in $100,000, great. It's going poorly. Liabilities are going up, assets are being depreciated, or I'm just losing money. I lose 20 grand. Does this owner's equity go down 20 grand as well, or does it stay because I invested 100,000 at 100,000?
It is going to change because you're taking your assets of the company and you're deducting the liabilities, and then so those assets plus owner's equity or plus the owner's contributions minus distributions and retained earnings, or retained earnings can be a plus or minus. That's where you get your bottom line. So if it's going to always depend on that retained earnings and what those distributions and liability or in contributions are doing.
Another example, if I invested $100,000 into my business, things went great. I made $20,000. Now there's $120,000 worth of value. Is the owner's equity that 120,000, unless I take 10 off and then it drops to 110,000? Like, is that the way that it works?
If you don't have anything else, any other assets, because assets are also included in owner's equity. So your assets minus your liabilities. If there's nothing else happening in that company and you have just put in 100,000, you made 20 and you took 10, then that 110 is going to be your owner's equity. Yes.
Perfect. And I know we're getting so technical and in the weeds, but it is so important for every entrepreneur out there to understand how this works, but also understand that you don't have to be actually doing it all. I hire bookkeepers for every single business that I have worked through, operate, and I'll admit a good majority of it is kept right here by Marie. And just to do that same little pitch through our company, check it out, fundersbookkeeping.com. There's the pitch. Okay, we talked about the balance sheet. That's that snapshot. I just want to dive into one more financial statement that comes up all the time, but actually it's the most important thing in the world if you ever ask me. Your profits and your losses statement, your P&L statement. Can you describe it a little bit?
This is the statement that's going to tell you the story about your business. It will give you insight to everything that's happening operational in your business. So you're going to see all your expenses, your income. You even will see some notes in there that, notes payable, especially if it's just small amounts. But how much are you spending on advertising? How much are you spending on utilities? How much are you spending on rent? Bringing all those expenses together in one lump sum to be able to see what is this business costing me month by month. So a P&L is one of the most important pieces of knowing what your business is doing. Just that information alone can help you make those decisions to how can I grow? Especially when you start taking your income and breaking it down by classes. I'm selling this over here. I'm selling this over here. Which one's bringing in the most money? Where should I put my time and energy? Expenses. It helps you to look and see where your money's going, because people will start a business and just go, 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 go. And then all of a sudden they're broke and they're like, where did all the money go? This is it right here.
Too.
This will tell you where all that money went.
So in terms of just kind of breaking down what each thing is, we have income. That just means revenues, right? Is there any other component of income that gets captured here?
Income is your revenues. Yes. Income is, there's different types of income, obviously. There's multiple types of income, but it is showing you money that came into your business.
Okay. And I'm looking at the P&L sample that you provided. We have costs of goods sold. High level, you're selling widgets. It makes sense. You buy a widget for $5, you sell it for $15. That's the cost of goods sold. Is that really that simple?
It's really that simple. What do you have to pay in order to get that money? So
now
it can be a little more complicated, because you can also see, like, who are you paying to help you get that money? So what salaries are cost of, not necessarily salaries, but contractors could be cost of goods sold, especially if you're selling services.
Okay, let me give you the example of my primary business, my law firm.
Okay.
I have employed attorneys that the payroll is way too high, but that's something else. But I have employed attorneys, and then I have, in the legal industry, we call it of counsel. There are contractors. Sometimes we're paying contractors for work. Other times we're paying our employee attorneys for work. And then we have the other payroll for marketing, administration, et cetera, et cetera. In that example, what's the cost of goods sold when we're talking about services?
So if you're selling services, and let's say you have this one client that needs services that you have to outsource some of that work, that's going to be a cost of goods sold. But if you have a client that needs services and someone on your team is providing those services, that's an expense.
Okay. I do want to get
Money you
into.
have to, well, and you did a great example when you were talking about a product. That's the easiest way for people to understand cost of goods sold, is that you buy a product before you sell it. So in order to sell that product, you have to buy it. This is how much you're spending. That $5 that you spend to sell it for 15 is the cost of goods sold. You did a
Sounds good.
example there.
Now, we have a couple of questions. I just wanted to cover these, but then get into the expense side of the P&L. And this, you may not even have the information or be the right person to ask. You're not a CPA. I know that. But the classic, I own an LLC. How do I reduce my tax liabilities if I also have a W-2 income?
Oh, yeah, I might not be the right person to ask that question to.
No problem.
I've never filed with a W-2 and an LLC. Well, I guess that's not true. So normally
Two different
filing,
things.
well, you can file your personal taxes and do a Schedule C. That Schedule C is going to be your business expenses. And so basically you're just filing your personal taxes with your LLC. If you're going to file them separately, then they're just separate taxes. You've got your personal taxes and you have your business taxes. So it's a matter of whether or not that person is a sole proprietor and they're going to combine those, or if they are, filing like the business separately from themselves.
Perfect. And Kajo, I actually know the exact answer here.
Yeah, tell me.
And it's exactly, no, I mean, Maria, it's what you explained, but just to put it in terms that I'm used to discussing, you start an LLC for yourself. The IRS considers it a disregarded entity. If you own 100%, you don't have to file separate taxes, but all of the expenses goes onto your Schedule C.
Yes.
The income goes onto your active income, completely separate and different from your W-2 income.
Right.
But at the end of the day, you make profits for your business, you're paying the taxes. And if you're not filing a separate return for the business, which you don't do if it's your own LLC, unless you elect for it to be taxed as a corporation, then it goes on to your Schedule C. Yay. Now leave me out of the rest of taxes because ain't a CPA. Go talk to a pro. Just like hiring Marie.
Lots of CPAs I talk to. If you have a question, I will call the CPA and ask them and then get back to you.
Great thing. And just so that you're putting it out there, and Kennedy, please throw it in chat. If anybody wants to get a hold of you, what's your email?
My email is marie@fundersbookkeeping.com.
There you go. If you don't mind throwing that in taxes or in the chat. We should leave this one question well enough alone from the Zen Pen. What's going to happen with taxes now that Trump is in office?
Oh God, let's not talk about that.
let's stay far away from that question.
I think we're all still wondering that question.
Yeah, without a doubt. All right. So now, thank you so much for the questions. Really appreciate them, and we'll keep answering them. But we got to the profit side, the income side of a P&L. Can you break down a little bit more? We have the income minus the costs of goods sold, but then we have the everything else expenses. Can you speak a little bit more to that?
Yeah. So after you do your income minus your cost of goods sold, you're going to get your gross profit. Your gross profit is the amount of money you can spend. That's your money that came in that month. You'll have operating expenses. So that's where you start, spending money. You've got rent, payroll, marketing. And if you're just starting out and you don't have a lot of employees, then you may have contractors instead of payroll. So after all of your expenses, your operating expenses are, paid in full, that's where you get your net profit.
Got it. Question for you from really a decision-making perspective. Is that the reason why each of those different types of expenses get categorized, or is there some other reason from let's figure out what to do, let's analyze how the business health is, that you would actually create the different categories?
Yes. Well, certain expenses, you want to categorize all your expenses because that's how you can get, like you said, a bigger picture of where that money's going. How, if you're trying to grow your business, you want to know where your money's going and how it's coming in. So what products or what services are bringing you that money, so you can make decisions on where to grow in those aspects of the business, and then where your expense is going. But it also helps you recognize if something is out of place, or if something is just gone up. Like, you might look at advertising and marketing, and your advertising and marketing, it runs maybe about $500 to $1,500 a month. Well, all of a sudden you're looking at your financial report, you see advertising and marketing is at like $5,000. You're like, whoa, wait, what's going on here? So breaking those categories down, it not only helps you to recognize where those expenses go, because you can just bulk everything into expenses for the most part. But then there's also certain expenses that are tax deductible and some aren't. You have meals, for instance. Everyone loves to talk about meals.
Deduct every Cheerio you can.
You have travel meals where you're traveling and you had to buy a meal. That's tax deductible. You have, and they change it every year, so it's probably a bad example, but let's just go off of what last year was. You have your meals and entertainment with clients, which they now say is no longer deductible, but it used to be deductible, fully deductible, 100%. And then you had your meals and entertainment where you bought some donuts for the office, or you ran out to go grab lunch or something with one person in the company during lunchtime. That would not be deductible. It used to be 50%, and now this year they're saying it's not. So it's very complicated. It's one of the important things to do is stay educated. Either hire a bookkeeper or accountant, or stay educated yourself on what those tax laws are and what's changing, what changes the IRS makes every year.
Well, let me rephrase that. You have to hire a bookkeeper unless you're doing it yourself. But if you ask me, especially for how, Marie, you're doing it for the smaller businesses, it's just a no-brainer to hire a bookkeeper to stay in order and just get that out of your, I gotta handle this too. So just really want to.
Yeah, I mean, you want that room to focus on your business. And if you're worried about the finances, or you're trying to figure out how does the system work and how do I track everything, you're not spending the time on the business to make it, to help it grow that you should be. So business owners need to be at the business. They need to be spending their time on focusing on the business, not the back end things that happen.
And if you ask me, it goes back to what I was talking about, where focus on those productive money-making activities and hire out as soon as you can all of the non-money-making activities like bookkeeping, HR, and get yourself an assistant, some office manager. And even if it's a VA, somebody that's in the Philippines, personally, I've had the same personal assistant, office virtual assistant in Kenya for like 4 or 5 years now. I mean, you can have great people that you don't have to pay that much.
Yeah.
But you can start to remove that. I'm not going to make money from this. For God's sake, try to spend as little amount of time as possible actually focused on it.
Yeah.
It's the exact same thing with the bookkeeping. For God's sakes, hire a bookkeeper rather than trying to figure it out yourself.
Yes.
Now, I've got some questions for you.
Okay.
And it's really, I'll be honest, it's based on a lot of what I've used you for before, that it's just areas that I don't really understand the difference. A lot of our viewers, they're, well, hustlers. They've got their business and operations that are going on. There's a whole nother set of listeners that do real estate deals and are working on their real estate empire.
Yeah.
Is what you're talking about different, or what are the differences if you're doing the bookkeeping for a business versus you're doing the bookkeeping for a piece of a real estate company? It wouldn't be literally the real estate itself, but whatever and whoever owns the real estate.
Yeah. So real estate's a completely different monster. And a lot of people don't understand it, bookkeeping wise. So, for small business, it's really straightforward. It's all about, tracking your financials and your growth and staying compliant. For real estate, there's a lot of financing structures, depreciation schedules, compliance with industry specific tax laws. You have your, valuations. I mean, for instance, revenue from real estate can be investors, and your investments are hold on.
Sorry to put you on the spot like this. I know, like curveball.
Excuse me. So you're going to have a lot of capital gains when you're in real estate, and capital gains are something that you don't show a lot of rev or income. Let's just say you're not going to have income if you're talking about development. Is like, give me a specific real estate to talk about. Let's say development.
Yeah, ground up development, and you're building a house.
Yeah. Okay. So you're going to have your property, which is an asset, obviously. And then as the building builds, that building becomes an asset that gets bigger, larger, and larger and larger. So, these are considered like capital expenses. They're not necessarily, if you're going to hire an engineer or an architect, you're not putting that in expenses in the company, but you're putting it in the building, because that's money you're spending to get this asset up off the ground.
Okay. And just so that we're clear, when you talk about it's a capital expense, are all the capital expenses you depreciate and deduct them through time, or I spend $50,000 on the civil engineer, I deduct that year $50,000?
No, it's depreciation over time. But really that doesn't start until you've had the building, then you're depreciating the building. So it's just feeding into the cost of the building. So when you build something in real estate, it's not to get that valuation, you're going to include every single cost that went into putting that building together.
Okay. So basically what you're saying is, if you're building a home and spending $200,000 on the land and construction and the architecture, and there's other components to it, you have no income. So your balance sheet shows zero revenue. You have these expenses, but until it's built, they're all capitalized, where you have to deduct them over time. They're assets. Okay. And then when I sell the house for $400,000, does it just directly 400,000 minus 200,000? There's my capital gain?
Unless there were other expenses with, pretty much, yes.
Bookkeeping, that type of stuff.
Yep.
Perfect. All right. I do want to answer another question that we got from Start Where You Can. And I love the name, because that's what we all do, is start wherever we can in life and business. So to answer your question, can you explain double taxation with a C corporation? Love to. love to hate it too. There's different categories of taxation. We have partnership. You don't really have a tax category. It's called a pass-through. Whatever the profits or losses are is reported on your personal tax return. And when you've heard about a Chapter S, an S Corp. S Corp, there's a lot of restrictions on how many people there are, how it has to be structured. But again, it's a pass-through, and you report the gains and losses and income directly on your personal tax return. But then we have the C Corps, and almost every single stock on the stock exchange, there's a couple of exemptions there, but they're all C corporations. With a C corporation, the corporation itself files for its taxes and pays its tax bill. Now, if there's profits at the end of the day and you receive a dividend, you're also taxed on the dividend that you receive. That's that double taxation of the corporation pays it. And then if you're receiving a dividend, you also pay it. And if you're investing passively into somebody else's business, that's a C Corp. That's how you're going to get money back and out of it. But I do want to just mention this because there's 1,000 ways to get around that double taxation. And it is, well, if you have a C Corp, it's your own. You're paying yourself income. You're co-investing into assets where maybe you're taking a little bit of a bigger ownership share. You can buy your own assets from the corporation. And then, of course, you can pay your kid for their amazing modeling. All of those are different ways to get money out of a C corporation without having to do the dividend. So you're really avoiding that double taxation. Don't trust me. Talk to your CPA. There's 1,000 ways to slice it, but ultimately your CPA is the one that will direct and protect what goes on there with the IRS, and they're the big bad wolf. Did I say anything wrong, Marie?
No, you're absolutely right.
Well, thank you so much. And we do have another question, and Charles asking about cost segregation and bonus depreciation. Marie, not going to put this on you. I'm going to bring up, hey, we're going to have another real estate focused CPA on entrepreneur very soon. So we're going to dive a lot deeper into that. But yeah, I will say,
a segment of its own.
Completely. And there's, reports that have to be put together and how all that works. And I got to tell you, that is not a bookkeeping function whatsoever. We are now talking about taxes and tax preparation, and your bookkeeper doesn't do your taxes. You should have your CPA do your taxes, and they're the ones that need to explain, report, and organize how your cost segregation and bonus depreciation gets applied. And what we're talking about really is it's dealing with real estate. It's not dealing with if you're starting up a business. I want to kind of emphasize, and then I'm just going to turn it over to Marie for some final words, just so that you understand. I don't care if you're starting a business, growing a business, or doing real estate projects. Your first line is hiring a bookkeeper to make sure that you're just collecting the data. If you have a quality bookkeeper such as Marie, they're going to be able to help you interpret the data as an accountant. But when it comes to your taxes, you're not relying on your bookkeeper. You're not relying on your accountant. 100% of the time, you should be relying on a CPA, or if you're just getting started, a cheaper way to do it. They call them enrolled agents. Enrolled agents basically means, hey, I've got a stamp of approval from the IRS to file your taxes and get paid for it. But they don't have the knowledge, education, or experience of a CPA that really, as you're growing your business, it's okay to start with an enrolled agent, but ultimately you want that. I'm going to save you tax money. Let's talk about bonus depreciation. That is 100% a CPA, something differently entirely. But today we are talking about bookkeeping. Thank you so much for going through those financial statements. We talked about the profit and loss statement. We talked about the balance sheet. And Marie, actually, before you give your final thoughts, I want to do this one last, helpful pitch for you.
Thank you.
I mean, it's only fair, really, because you're offering the best deal out there. But if you do want to and need to start an entity, start moving forward, fantastic. What they're doing, okay, we even have your phone number, 469-654-4444. Only $50 a month to get you started enrolling your bookkeeping. For God's sakes, reach out to Marie and get all that rolling. If you have your business entity, don't worry about it yourself. And with that, Marie, you have any final thoughts or complaints that you want to complain about me or share with the audience?
So one final thought I do want to give is and this is probably the best advice I could give you as an entrepreneur to an entrepreneur that is getting started and is just taking that first step. Separate your personal from your business. Keep your personal and your business activities completely separate, because that right there is where you're going to lose. It's going to cause you're not going to know what's what. And a lot of people start out, they're just using their bank account, their personal bank account, they're paying business expenses. And so bringing in a bookkeeper is number one. It's not going to cost you a lot of money to get started. It's something that's going to keep you in line when it comes to keeping those business and those personal things separated. Just track your daily cash flow, someone that's going to help you create a budget even. And then the other thing is to work on that cash reserve, because, you need to have a 3 to 6 month cash reserve, and we can help you do that. We can help you plan. So it's best advice I can give.
And you know what? You brought up two of the most important points that we do make repeatedly. The toughest part is getting off the starting line. You got to get moving forward, because if you're just stuck in analysis paralysis, you never get moving forward. So for God's sake, do what you need to do to get your business going forward. It is the best way nowadays to enjoy that American dream. Second thing that Marie brought up that I just really want to emphasize is use a limited liability entity so your family is not at risk. Use separate bank accounts so your business is not at risk, and ultimately you're saving on taxes. So thank you so much for joining us today, Marie. We've got your information all over the place. It'll be in the summary as well if anybody needs any help with this. And I can tell you, everybody that has a business needs help with this.
Yes.
Really appreciate you today. Thanks for joining.
I appreciate you having me. Thank you.
All right, guys. Really, thank you so much for taking the time to listen, to learn, to love some of the questions. Thank you all so much. We'll be back next week talking all about entrepreneurship, business, and different areas to help you succeed. So thank you all, and see you again soon.